you through a trade that I took not that long ago. I'm going to talk you through all of the elements that I considered in order to take that trade. And I'm going to basically show you a full breakdown from the fundamental side, the macroeconomic side, the technical side, right the way through to trade execution. Now, hopefully in the process of that, that will throw up some opportunities for me to teach you a few things. It'll also throw up some opportunities for you to ask some questions. At any point as we go through this, if you have any questions, please do feel free to ask. Okay, if I think it's better to wait to answer it till the end, I'll say that. But if I'm happy, if it fits in nicely, I'm quite happy to keep this relatively free flowing, quite fluid. So we'll take it as we go. Alrighty, but that's the aim of the game. We're going to have a look at a trade setup, and we're going to try and cover all of the key elements that you ultimately are going to need to consider if you want to be a successful trader. Okay, now some of the key tools which we're going to have a look at and elements we're going to have a look at. Okay, we're going to have fundamental and economic cycles. Okay, now fundamentals effectively is looking at the news within the market. Okay, what headlines are out there, what's going on. So for instance, at the moment, the conflict in the Middle East, that is a fundamental driver of the market. Oil prices over the last couple of days have gone up off the back of the escalation in Iran using ballistic missiles into Israel. Okay, that is a fundamental driver that has created a move in, for instance, the oil markets. Now, when we talk about fundamentals ultimately are the reason why an asset, the price of something, goes up or down. Okay, unless there is a catalyst, unless there is something going on, the market has very little reason to move. Okay, so understanding the fundamentals is critical. Part built into that is then the macroeconomic data. So this is the data which really drives the economy, gives us an understanding of is that economy performing well or not. And we're going to look at that in quite a bit of detail this evening for the trade setup which we took. And then the last element which we're going to look at out of this list of 5 is going to be technical analysis. So if fundamentals and the macros are the reason a chart moves, so for instance, as we said, conflict in the Middle East, escalation with Iran, firing ballistic missiles, we know from that it's quite likely oil markets, for instance, are going to go up. It's a threat to supply, and therefore less supply of something, typically it becomes more valuable. Okay, if there's less of something in the world, generally you have to pay more for it. So oil markets moving higher off the back of that, outside of just closing your eyes and clicking buy, which clearly isn't a particularly good idea, you have very little else to go off. And that's where technical analysis comes in. Okay, so the fundamental and the macro is why something moves. The technical is how it gets from point A to point B. So I think oil should go up because the escalation in the Middle East, and I think it's going to go up from here to here based on the technical analysis. Okay, as it says there, it paints a picture of actual price action. Okay, now we're not going to focus too much on quantitative or behavioral analysis this evening. We're going to focus predominantly on those 3: fundamentals, macroeconomics, and technical, and in particular, the macroeconomic data and the technical data. Okay, and the trade which we are going to focus in on is a trade in the currency markets. Okay, it's not something that I would typically trade, to be honest. Like I said, I typically trade soft commodities, commodities in general, oil, gold, and the bond markets. But this was just a really excellent macroeconomic setup. There was a lot going on, plenty of reasons to want to take it. And sometimes you just have to steer away from your wheelhouse and go with what opportunities are being presented. And I'm just going to try and break it down in as much detail as I can, and just give you as best I can an insight as to what being a trader is all about, some of the considerations you need. Now, I am going to say straight off the bat, if you are completely new to trading, there's going to be quite a lot we discuss tonight which you don't fully understand. That is natural. That's obviously going to be the case. Okay, but hopefully what I can do is at least whet your appetite, get you excited about trading, show you, what it's all about, some of the considerations. And if you were sat on the fence before about whether you should do this or not, hopefully I can give you the nudge you need to give it a crack. Exchange currency is part of it. So the currency which we're going to trade the Australian dollar against the Canadian dollar. So we're looking at here trading the Australian dollar, okay, and its relative strength to the Canadian dollar. So I can trade currencies against each other. The most kind of widely traded is the British pound against the US dollar. Okay, it's exchanging pounds for dollars, or trading euros for dollars. That they're two of the biggest currencies traded globally. There's around $7 trillion a day gets traded in euro dollar alone. So it's a massive currency cross. Australian dollar against the Canadian is nowhere near those kind of volumes, but it's still perfectly tradable. So the trade we're looking at here is what is the value I am betting, I'm going to trade here that the Australian dollar gains in value versus the Canadian. That's going to be the trade, and I'm going to talk you through how I came to that conclusion. And the first thing that we need to discuss, as I said, team, any questions, fire away. Doesn't matter if it's off topic and random. Now's as good an opportunity as any to fire some questions at me. Okay, central bank policy. We have to start with this before we can go any further. And I want to talk about interest rates in particular. Okay, so we have in control of Australia. Okay, we have what's called the Reserve Bank of Australia. And in Canada, we have the Bank of Canada. In the UK, we have the Bank of England. Every economy has a central bank. Okay, and the role, any reason why you prefer those commodities? Yeah, I really like trading supply and demand. There's a really clear narrative with commodities that if there is less of something, it becomes more valuable, and if there's an abundance of something, it becomes less valuable. And they react very well to breaking news, like the oil story the last couple of days. I had a lovely trade yesterday, just reacting to the headline because it was a very simple. Iran escalated the tension. That puts a pressure on the supply chain. If there's less oil, it's going to become more valuable. And commodities tend to be quite simplistic with that. So something like wheat, I'm trading a huge amount of at the moment. There is simply less wheat in the world. Yields were particularly poor this year. Bad weather conditions crippled a lot of northern and southern hemisphere farming. And as a direct result, wheat has seen some positivity off the back of it. So I just like the supply and demand narrative. I think it plays out very well in the commodity sector. Excuse me. Okay, so every major economy will have a central bank. And one of the main mandates of a central bank is to control interest rates. Okay, now when we talk about interest rates are the cost of borrowing. Basically, how much is it going to cost you to borrow a certain amount of money? Okay, right now, anybody trying to get a mortgage or remortgaging is having to pay a significant amount more than they were each month because interest rates are very high. Yeah? If you wanted to go and start a business when interest rates were very low, that was a good time to do it. You'd have to pay the bank back a very small amount of money. Now, whether you as a central bank are cutting rates or raising rates has a massive impact on your currency. Okay, and there are two terms here. You can see at the top of my chart, we have what we call hawkish and dovish. Now, if a central bank is hawkish, they are of the opinion that they are going to raise interest rates. Okay, if a central bank is dovish, they're of the opinion they are going to cut interest rates. Okay, and when we do that, we have a really profound impact on quite a lot of elements. And the first impact is on the currency. So what I want us to focus on is the hawkish side. Okay, that is saying that the central bank want to raise interest rates. So let's take the Reserve Bank of Australia. Okay, the Australian Central Bank. Let's assume they are hawkish and they want to raise interest rates. When they do that, that currency becomes more desirable to own. Okay, if you own Australian dollars and they're in an Australian bank, you are going to get paid a significant amount of interest in the bank. Okay, you're going to earn quite well on that currency, and therefore it becomes more valuable. Okay, so the local currency, when they are hawkish and raising rates, increases. Okay, and that singular thing creates a chain reaction through a lot of the macroeconomic data. Okay, if we're looking at imports, for instance, you can see they also go up. If your Australian currency has got stronger, you have the ability and the purchasing power to go and buy a product from another country with your Australian dollars because they are worth more. Yeah. Or as a consumer, you can afford to go on holiday because your currency is worth a little bit more. Flip reverse that, your exports decrease, okay, because you as a central bank and as a nation, you have a very expensive currency. If I was sat in the UK and I was like, right, I'm going to go on holiday to Australia, and the Australian dollar is incredibly valuable, then my pounds aren't going to get me much, right? My pounds are going to get me a rubbish hotel or an expensive beer or whatever. Everything starts to become really expensive. So you tend not to go on holiday to that country. That's why, it's why we like going to places like Thailand, okay, because they have a very good currency exchange. Your pounds gets you a fantastic hotel, yeah, because it's just considerably more valuable than the local currency. Okay, so your exports start to decrease. You become very expensive and people don't want to purchase from you. Okay, if we look at, somewhere like the US and Donald Trump, make America great again, his age-old slogan. In order to do that, he wanted to bury the US dollar. He wanted to make it impossible for anybody to go and purchase something from another country. He wanted to make sure everybody came to the US and spent some money because they were cheap. And he wanted to make sure any businesses and any consumers in the US were forced to look domestically and look internally to encourage growth. Okay, in this scenario, in the hawkish scenario, we're doing the opposite of that. We're encouraging people to go elsewhere, to look overseas, and we're acting as a deterrent and preventing people from wanting to come and spend money in Australia. And as a result of that, you end up with low GDP. Now, GDP stands for gross domestic product. It's growth, basically. How much growth is that economy seeing? And in this hawkish scenario, we're seeing a real slowdown in growth. The pound isn't the strongest currency. It's a relatively strong currency, certainly versus some of the others. That's just the nature of it. It's a very well-established economy. It's got a huge amount of business. It's just a bit of a powerhouse globally. It's probably not the strongest, but a huge amount of trade and companies operating from the UK. Okay, so growth in a hawkish environment starts to decrease, starts to slow down. Okay, now the Purchasing Managers Index, which is a measure of the manufacturing sector and the services sector. Ultimately, this is basically going to people holding the purse strings. So if I went to the CFO of a manufacturing company, let's go to someone in the UK, let's say I went to the CFO of Rolls-Royce and I asked them, how confident are you at the moment? If they were very confident and they were spending money and they were booming, the PMIs, the Purchasing Managers Index, would go up. And if they were struggling and they were contracting and they weren't making any money, the PMIs would go down. They would be lacking confidence. So in this hawkish environment, they are lacking confidence. It's a really negative time for them. And of course, with that, the unemployment rate starts to go up. Now, this is all really important macroeconomic data for every economy. And every central bank is tracking this data and trying to figure out what is best for future interest rates. What should we do going forward? And the most important, there's two really, most important are GDP growth. What is the growth of that economy? And secondly, inflation. Inflation has become a real talk of the town of late. Okay, and every single central bank is in a fight and a battle to bring inflation back down under control. And this battle with inflation has created what we call policy divergence. It's caused central banks to have to act differently. And the two central banks which we're looking at are the RBA, the Reserve Bank of Australia, and the Bank of Canada. Okay, and that's what I want to, there is not risk of deflation in doing that. Absolutely. So when you are hawkish and you're trying to slow down the economy, you run the risk of deflation. Now, deflation, you have to have a certain level of inflation, typically 2%. Without inflation, you can't grow. Chris, you should hopefully be able to see just the central bank policy at the moment, the table, just the table of hawkish and dovish, hopefully. Okay. Now, when you target inflation is 2%, when you are hawkish and you're raising the value of the currency, you are bringing down inflation. Okay. When you are dovish and you're decreasing the value of the currency, you are increasing inflation. It doesn't seem to be sharing for me. I can still see the title slide. Can anyone see? Can no one see the chart that I'm on? Okay, that's going to make life very difficult. I'm glad somebody said something, otherwise I've gone the whole presentation without without you being able to see anything. Can you see that? Right, so it seems that when I put it in presentation mode, you can't see anything. So we're going to have to do this the old-fashioned way. I'm going to try and make this as big as possible without... I should be able to hide this, I think. Can I hide this? There we go. Right, let's go with that. Okay, well done, Chris. That must have been all very confusing without being able to see that. Apologies, glad we've got this now. Okay, so this was the table which I was hopefully showing you. Okay, this is the table, right? Let's do a quick recap then. So left-hand side is hawkish, right-hand side is dovish. So hawkish, you're raising interest rates. Dovish, you're cutting interest rates. Okay, so you're either raising rates or cutting rates. Hawkish side, when you raise interest rates, you increase the value of the currency. And importantly, the most important element is when you do that, you decrease inflation. On the dovish side, when you decrease the value of the currency, you're encouraging spending, you're encouraging stimulus and growth and positivity, inflation increases. And this is what we saw in a post-COVID world. Would it be raising quantity or price of imports, exports, green, red arrows? So this would be just the total of imports and exports. So if the value of the currency is going up, your total value of imports would go up. Yeah, so we'd just see more imports, not necessarily the individual cost of those imports, but the total imports being brought in. Okay, so imports become far more desirable if your currency is more expensive. Your purchasing power is higher, you can afford to go and spend money elsewhere. Okay. Now, the biggest key metric for most central banks at the moment is inflation. When the currency goes up, inflation goes down. When the currency goes down, inflation goes up. In a post-COVID world, inflation was out of control, and I'll show you that in just a moment. Okay, because interest rates were basically zero to try and offset the challenges of COVID and lockdown and furloughs and people not spending. Interest rates went to zero. It did a fantastic job of stimulating the economy, but inflation then was out of control. Inflation went up to 11% in the UK, 9% in the US, 8% in Australia, and 7% I think in Canada, something like that, way beyond the 2% target. So what the central banks had to do was raise interest rates. Now, why some countries like Argentina had high levels of inflation? Yeah, because they also had, they were in real economic slowdown. They were really struggling. And so what they did was they slashed interest rates to try and encourage as much spending as possible. But in doing so, they devalued their currencies so aggressively, and by so far, they became completely lacking any competitiveness with other countries around the world. Japan did a similar thing, and they just devalued their currency so much it started to put huge pressure because people would go and spend money in that economy in Argentina. They also have a huge exportation of raw materials, and raw materials went through the roof. The likes of timber and lumber went up by like 800% coming out of COVID. And all of that just filtered down into some of the biggest contributing factors for their economy, which created this insane inflation bubble. Every economy around the world saw it, but some of those more emerging markets saw it on a much greater, more severe scale. Okay, now coming out of COVID, inflation, like I said, hit 8, 9, 10%. And so what the central banks did is they raised rates very rapidly, and both did the same. You can see on the left-hand side here is Australia. They went from 0 to a little over 4%, and they did it from the start of 2022 or summer 2022 till the end of 2023, basically. Canada did exactly the same. They went from 0 up to a little over 4.5%. So they were marginally higher, but still it was very similar, from March, April time 2022 to the end of 2023. Interest rates went up, 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 up. And what that did for both currencies was it created positivity. The Australian dollar started to strengthen, but so too did the Canadian dollar. And with that, it generated a slowdown in inflation. Now, where the divergence comes in, and divergence basically means we have a difference between two things, is you can see on the Canadian chart here, they have started decreasing interest rates. Can central banks do that without asking other countries' permission? Yeah, absolutely. They sit independent. They also sit independent of the government. So the RBA and the Australian government has no control over the RBA at all. They will be in discussion with each other, but if the RBA believe the best thing to do is to cut rates or raise rates, they will do it without any permission from the government, and certainly not from any other countries. Now, the reason they do that, if you take the US as an example, Jerome Powell is the chairman and the president of the central bank. He has a very different mandate to the president of the United States. The president is trying to win votes and make everybody a load of money. Jerome Powell is there to bring stability, and the Fed, which is the central bank of the US, is there to bring stability to that economy. Okay, what is best for the long-term security of this economy? And that sometimes means the central bank being the bad cop. Raising interest rates like they did here is not good. That is bad for your economy, but sometimes it is necessary in order to slow down inflation, for instance. The president of the US or the prime minister of Australia will have a very different stance. They will just want it to keep going up and up and up. Okay, so they sit completely independent. Now the divergence comes in here because the Bank of Canada have started cutting interest rates. They've turned dovish. They're trying to decrease the value of their currency. And you can see the Australian dollar and the RBA, they are not yet. So we've now got divergence. The Bank of Canada are cutting rates, devaluing the Canadian dollar, and the RBA are keeping rates nice and high, still increasing the value of the Australian dollar. Now, the reason that they're doing that, as I said, is because of inflation. Now, what we've got here is the Australian inflation. And this is why Australia have a problem at the moment. Their inflation, you can see it on the right-hand side there, the chart, inflation was up at 7.9%, right the way up here, way too high, the orange line. It then came down to 3.6. And the RBA were sat there going, okay, this looks pretty good. We're on our way down towards the 2% target. Perfect. However, right now, their inflation has started going back up. It's gone from 3.6 back up to 3.8. Okay, now for anyone that doesn't know, inflation basically is a measure of the average cost of goods. So it takes a basket, depending on which country you're in, of anywhere from 800 to around 2,500 products. And that can be car insurance, getting your hair cut, filling up your car, heating your house, buying a loaf of bread. It's just anything from a day-to-day item right the way through to something more expensive. The average price of a BMW, for instance. It then adds up the total value of that basket of goods, and then it tracks how much does that same basket of goods cost now versus a year ago or a month ago. Okay, so that's all it's tracking, and it should go up by year on year. It should go up by about 2%. Okay, if it goes up any more than that, life starts to get very, very expensive. That's where we are at the moment, aren't we? The cost of living at the moment is very expensive. And so that ultimately that's what it's tracking. And they're trying to get to 2% because that's where is safe and stable. Once they get down to 2%, then they can start cutting interest rates. But they can't do that until they get down towards their target. Okay, so Australia were at 3.6 and they were heading in the right direction, and now they've gone to 3.8. They're heading in the wrong direction. Can you say why Australia dipped into negative rates in 2019? Yeah, this was the initial. So the inflation rate, as soon as COVID hit, basically, there was a sudden, just complete stop. Life just froze, right? Nobody spent anything. Nobody did anything. Everyone went into lockdown, furlough, and it created basically just a huge contraction because everyone just froze. And so we saw a really rapid sort of dip into it. And then once the stimulus packages came in and they started relieving and providing low interest rates and basically telling the world, don't worry, everything's going to be okay, we're going to help you out here, then inflation started to rally. But that initial panic just shut everybody down and just stopped people from spending whilst we were trying to figure out what happens next for life and humanity. Okay, now if we compare that to Canada, here's Canada's current inflation. Look at their path. You see the yellow, the orange line here, how it is just continually grinding lower. They are down, or were down, to 3.8%. Okay, and they're now down. Oh, don't know why I've said 3.8 and still declining. Okay, I should have changed that. Sorry, they're down to 2%. Okay, and still declining. Okay, you can see on the right hand side that orange line. Okay, they're down to 2% and it's still heading in the right direction. So as far as the Bank of Canada are concerned, the high interest rate has done its job. They did that to get inflation back down from the 8.1% where it was, back down to 2%, and they have achieved that. So they're in a position now where they can sit there and go, right, we've done it. We can start to cut interest rates again. The other measure that they have is also what's called core inflation. I won't explain what that is now, but it's just another measure of inflation. And that's actually in negative 0.2. It's actually in deflationary territory. So Canada is in a massive slowdown. Economically, they're in a really, really tough position at the moment. Don't know if we have any Canadians on the line, but they're in a really tough position. So in order to stimulate growth, to stimulate positivity, the Bank of Canada need to cut interest rates. When you cut interest rates, you reduce the cost of borrowing, you encourage people to spend. And when you spend, the economy grows, the economy expands, and everybody becomes more happy about life. There are more jobs, there's more business being done, the economy starts to grow. So now we have a divergence. We have the Australian, let's bring it back here, the Australian Central Bank who are looking at inflation and going, oh no, it's going up. We're nowhere near 2%, and it's now going in the wrong direction. As a result, they are remaining hawkish. The RBA, because of inflation, are hawkish. That then increases the value of the Australian dollar. The Bank of Canada are now turning dovish. Okay, let's come back to that table here. Okay, so the RBA are hawkish because inflation is back or is not yet under control. They're still trying to bring inflation down, so they're remaining hawkish, strengthening the currency. And dovish, okay, is the Bank of Canada. They are trying to cut rates because their inflation is actually back under control, and now they're trying to bring stimulus. Was the world economic crisis manipulated by a few policymakers? Oh, I'm not going to try and answer that question, Spartak. I'll sound like a conspiracy theory. Yeah, sorry. Personally, I don't think so, but I'll leave everyone to make their own call on that. Okay, so right now we have the divergence. Okay, we have inflation in Australia, which is still out of control. So they are continuing to keep rates high. And we have the Bank of Canada, where inflation is under control. So they're looking to cut. So the Australian dollar should get stronger. The Canadian dollar should get weaker. Does that make sense, team? Are we following that? I appreciate those of you completely new to this. It's going to be a reasonable amount to take on board. But even if it doesn't make 100% sense, at least you can see the process and the narrative. The next element to consider is growth. Okay, we said growth and inflation, two quite important metrics. Now, on the left-hand side, you can see the Australian growth rate, GDP. Okay, and you can see how it's been pretty consistent, right? It dropped, in Q3 of 2021 in a post-COVID world, but actually, it's kind of remained steady for all of 2023, 2024. It's kind of been around 0.5%, 0.2%. It's been in growth territory. Okay, yes, it's slow, but the economy is still growing. Okay, now you would cut interest rates when there was a lack of growth. Compare that to the Canadian side. They had two recessionary prints where growth went into a negative. If you think the Canadian dollar will appreciate, would you want to buy Canadian dollars forward in exchange for Australian dollars? Correct. But in this instance, I'm making the assumption the opposite of that's going to happen. I'm assuming the Australian dollar is going to appreciate against the Canadian. But if in that scenario, Matt, with what you're talking about there, yeah, absolutely. If you felt the Canadian dollar was going to appreciate, you would short the Australian dollar against the Canadian. If you felt the Canadian was going to get stronger than the Aussie, yeah, if you go short something, you think the term currency. So in this instance, if you're trading the Australian dollar against the Canadian dollar, let me just do a little drawing. Oh wow, that's a big old brush. That should get the job done. Okay, if you're trading the Australian against the Canadian, okay, which is the way you would always trade this pair. You wouldn't trade Canadian against the Aussie. The Aussie is always the base. Oh my God, sorry, I'm useless with that. The Australian is what we call the base currency. The Canadian is what we call the term currency. So if you think the Canadian dollar is going to get stronger versus the Aussie, you would short this pair, i.e. you think it's going to go down in value. If you think the Australian dollar is going to get stronger versus the Canadian, you would go long this pair. You would buy into the Aussie against the Canadian. Oh my God, how do you do this? Okay, we'll have a look at exactly how that trade will play out as we make our way through this. Okay, so you can see there Canada have actually had two recessionary prints, okay, which is really negative, okay, and that will have scared the Canadian Bank of Canada into thinking, wow, we're going to need to act. We're going to need to take action here to try and prevent this getting any worse. Okay, so from a data perspective, we've got the inflation story, which supports Australian dollar going up, Canadian dollar going down. We have a growth story, which also suggests the Australian dollar is pretty stable, so that's good, and the Canadian dollar is showing some pretty scary signs of recession. The other element to consider in here, and I appreciate I'm throwing a lot at you here, but I just want you to see as much as you possibly can in the time that we've got, is correlation. Okay, now what we're looking at here is the candlestick chart, this one coming up through here. This is the S&P 500, which is the benchmark index in the US. So it's a measure of really economic performance. If this is going up, generally the US is pretty happy and companies are doing very well. And if it's going down, companies aren't doing particularly well and things are quite negative. Now, it has a correlation with the Australian dollar, which is this sort of purpley pink reddy line here. Okay, I've just overlaid the chart. And you can see as the Australian dollar goes up, so too does the US index. Now, the US index is more important. That's the benchmark for general global economic health. So when the S&P 500, the index, goes up, it drags the Australian dollar with it. Okay, now the rationale for that is a bit of a chain reaction. Let's start with the consumer. If the US consumer goes and buys a television, okay, whatever television that might be, whoever has sold that television will have made money. Okay, let's do Apple. Let's make something which everyone can relate to. Okay, the US consumer goes and buys an iPhone. They buy the iPhone from Apple. Apple sees an increase in revenue because the consumer has bought a phone. Apple also therefore needs to produce a lot more phones. Okay, in order to build those phones, they are going to need raw materials, in particular precious metals. They're going to need a lot of copper, they're going to need gold, they're going to need a lot of precious metals, a lot of raw materials. They're also going to need raw materials to power the factory to make that phone. Now, a huge proportion of the world's raw materials come from Australia. Okay, Australia has a huge mining sector, so does South Africa, so does New Zealand, so do a lot of the emerging markets in South America. But Australia's largest export is raw materials. So when an economy is booming and people are spending money and buying products, and we're making a lot of products, the Australian dollar also does very, very well. And right now, the US markets are booming. Okay, they are in this big, massive uptrend, and they have been now. Since COVID, it's done nothing really but go up. Okay, so that move higher and that booming US economy is also going to help strengthen the Australian dollar purely by a nature of correlation. So we've got central bank policy, which means the Australian dollar should go up. We also have correlation, which means the Australian dollar should go up. Okay, does that make sense, team? Again, any questions? Far away. Correlation's a really powerful tool in trading. You know, if I'm trading wheat, for instance, I've traded no end of wheat futures over the last couple of weeks. I'm always looking at my correlating markets. I'm looking at soybeans. I'm looking at soybean oil. I'm looking at corn markets. I'm looking at UK wheat markets to try and see, are they all showing signs of positivity? Are they all showing a similar trend? And that's what we see here most of the time. So if I want the Australian dollar to go up, I also want to see the US economy booming, which it is for now at least. Okay, so we've got central bank policy. We've also got correlations. We also have the bond markets. Okay, now this is a really interesting chart. What I've got here is a yield curve. Okay, and what I'm looking at is the yield. So what is the return on a bond? Okay, now a bond, in this instance, 2-year bonds, is a means of raising money. So the Australian government will issue bonds. They'll say to the consumer or to companies, will you lend us money? If you do, we will pay you back with interest for 2 years. That's basically what it's saying here. The Australian government will then go and spend that money on infrastructure, housing, whatever it is, building better roads, doesn't matter. They can spend it on whatever they like. You have lent them the money, they will spend it on whatever they want, and they will pay you back with interest. Okay, that's the general aim of the game with a bond. Now, what I've done here is I've compared the 2-year Australian yield and the Canadian yield. Okay, so there is a direct correlation between yields and interest rates. If the yield on a bond goes up, it's because interest rates have also gone up. So the bond market's become a really, really good way of tracking and monitoring what is likely to happen with future interest rates. Okay, so in this instance, the Australian yield, because this chart, you can see this trend is going higher, that's telling me that 2-year yields are higher in the US than they are in Canada. And so that tells me short-term interest rates, over the next 2 years are going to be higher in Australia than they are in Canada. It's a really good way of just confirming the narrative that we had at the start about central banks. Telling us, there's a lot of positivity in this. Interest rates are going to be higher. Remember, who can remember the name of that? If interest rates are going to be higher, what do we call that in central bank terms? Anyone remember? Perfect, Matt. Yeah, absolutely. That's hawkish, isn't it? Excellent. Good stuff. So that's telling me that short-term interest rates in Australia are higher than short-term interest rates in Canada. Again, that supports the argument for a hawkish RBA and therefore stronger Australian dollar. So the bond market, the correlation, and the central banks are all suggesting the Australian dollar should be stronger than the Canadian. Okay? Again, are you going to fully understand bond markets following on from this chat? No, but hopefully I'm just trying to give you an insight as to the sort of things that we're looking for. Now, that's the kind of fundamental and macro view, right? A slide I don't think you even saw at the start because I was just sharing the front page for some ridiculous reason, was probably this. Okay, these are the key considerations for a trade. What's going on fundamentally? What's going on with the macroeconomic data? What's going on with the technical analysis? So we said at the start of this, the macros and the fundamentals, all that stuff we've just talked about, that is the reason why something goes up or down. The technical then tells you how is it going to get from point A to B and when is it going to do that. Trying to time your entry. I could have had this opinion, but the RBA were hawkish and the Bank of Canada were dovish and yields were doing this. I could have come up with all of this good stuff, but that same story has been true for the last 3-4 months. So trying to cherry pick the exact moment that you actually take a trade is very difficult. And that's where technical analysis comes in. Okay, and that's what we're going to talk through now. So we have the reason why it should go up. Now it's a question of how is it going to go up? How am I going to execute this trade? Okay, and that comes down to then your technical setup. Now, what we're going to major on, if you join us at the academy and what I'm doing every day and the rest of the traders in the team are doing every day is we're trying to piece together both. It's possible to be a purely macro trader. You only look at the data and you only look at news. Fine. It's also possible to be an entirely technical trader. You have no consideration for the news. You only look at technical analysis. Again, fine. Ideal scenario, you have a little bit of both. How much? It's not necessarily 50-50. You might major in certain assets and a certain skill set. But you should ideally have a little bit of both. Is technical analysis very accurate? That's $1 million question. I'm going to say no. I think all of you are new and aspiring traders, and I have no doubt if you've landed on this seminar, you've already started doing some research, right? So you'll have watched some YouTube videos, and I'm not going to knock YouTube. There's some good stuff out there, but you'll have also maybe read some books. You'll have started seeing some Instagram posts or whatever it might be, and you're going to have people screaming from the rooftops that technical analysis is what you need, and you need sort of smart money concepts, and you're going to have this technical level here and this moving average and this indicator and this crossover, and if this and this happens, do X, Y, Z and you'll make money. Let's be completely honest, if that was the case, we'd all be very wealthy. I probably wouldn't be sat doing this webinar to you. I would have retired by now. Okay, it's a much longer journey than that, and technicals alone I personally don't think is going to get you over the line. Yes, they are massively important. And yes, they can be the key to having a good trade, but by themselves, probably not enough. Yeah, I think you need to build up a really good fundamental, a really good macro reason for something, and then the technical is going to help you find your way. Okay, but let me put it to you a different way. Let me put it to you in a really naff analogy. I want you all to liken trading to crossing the road. Okay, if I went up to a really busy dual carriageway, middle of rush hour, and I closed my eyes and I walked out, the chances are I'm going to die. I'm going to get hit by a car. It's going to be almost impossible for me to make it across there. Okay, I did no due diligence. I just opened up my trading platform, I closed my eyes, and I clicked buy. The chances of me winning are pretty much zero. If I walk up to that road and I look left and I look right, I've increased my chances of getting across the road safely. Yeah, I can, of course, I still have a very high chance of getting hit. If I just walk across 4 lanes of traffic, even if I've looked left and right, the chances are something's going to get me at some point. But that first bit of due diligence to look left and look right is perhaps to learn about central bank policy. If I get to that dual carriageway and I look left, I look right, and then I go, oh, actually, you know what? There's a set of traffic lights down there. I'm going to go to those traffic lights. If you wait for that light to go red and the little green man goes green and you cross the road, you have significantly increased your chances of getting across the road safely. Now you've learned about central bank policy, you've learned about macroeconomics, and you've understood the technical setup. At the end of the day, the moment you step foot in the middle of that road, can you still get hit? Yes. You can do everything right. Yeah, you can do your macros, you can do your fundamentals, you can do your technical analysis, you can go to that set of traffic lights, you can wait for the little man to go green. The moment you step out into the road, someone runs a red light, drink driver, whatever it is, bang, lights out. It is no different in trading. You can do the best analysis and the best due diligence and the best technical setup, and I could have done everything I'm talking to you about right now. When I pull the trigger, I have absolutely no idea what's going to happen in the future. I have what I think is the most likely, the most probable outcome, but there's no way I can guarantee that. And it's foolish to come into this thinking that you can. There has to be a level of acceptance that sometimes things just don't work. Okay, so do I think technicals are perfect? No. Do I think they get you closer to getting across the road safely? Yes. Is it going to help you get across the road safely every single time? Absolutely not. Okay. Yeah, you absolutely. Okay, a couple of questions here. Sorry. Do you think efficient market hypothesis works? No. Uh, it's a lovely concept, but I don't think it's anywhere near reality. I think efficient market hypothesis gets blown out of the water just purely because human emotion takes over far too much within trading, and I think behavioral analysis becomes more important at that point. Can you make a living with trading? Okay. I mean, the obvious answer is yes, absolutely you can, but there are a huge amount of variables with that. One of them, firstly, being how much cash do you have to trade with. There also has to be an. I'm not going to. I'm not. There's no way I'm going to sit here and sell you a dream. I've been trading for 9 years. I lost money for 3.5 years. It's been one of the hardest journeys I've ever been on. I have no regrets whatsoever. I love trading, and I've been fortunate enough to make a career from it, not only teaching it at the academy, but also trading my own personal funds. Well, actually, I now trade proprietary funds, but and I've been fortunate, but I also see a huge amount of people come and go who don't make it. So I think you need to come into it with the right intentions. You have to really enjoy it and want to do it. You have to have the right drive and determination and recognize that it's going to be difficult. And if you want to make it, if you want to be able to live from it, you also need to have enough capital. Now, proprietary trading has made that a lot easier for people because you can get access to a significant amount of funds. And if you come through our course, we are going to, if you pass the level 5 diploma with us, we will give you access or at least the opportunity to sit a challenge to get $100,000 account which then is enough capital to make a living from it. So yes, it can be done, but it's very difficult. And yeah, I'm not going to make you any. Sadly, not going to sell you the dream that you'll be rich overnight. It's a long journey ahead. Well worth it. Don't get me wrong. Absolutely, it's worth it, but it's tough. Would market volatility be a factor that could affect a very good technical analysis? Yeah, absolutely. Now, a lot of people shy away from volatility. Personally, I love volatility. It provides big opportunities. But for instance, I could have a perfect technical setup to sell oil, right? To go short oil yesterday. If a headline comes up like it did, and the US Defense Department say Iran are about to launch ballistic missiles, my technical setup doesn't mean anything, right? Everyone just becomes very knee-jerky, very reactive, and they just aggressively try and buy oil as quickly as they can. So volatility can still work with technical analysis, but not if that headline is completely dominant. The ideal scenario, of course, is you have a technical setup and then the fundamental volatility supports it. So if I had a technical setup to buy oil and then the headline came out yesterday, well, that's a win-win. That's when you're going to get the biggest move. But if there's a big enough and a great enough headline come out, that's going to blow technicals out of the water. But that's a rare occasion, but that happens, right? Okay, so let's move on. Good questions, team. Hopefully I'm doing okay answers wise. If you want something explaining more, please just say, team. You've got my time here this evening. We might as well make the most of it. Now we're going to get stuck into the technical setup. Okay, now I'm going to try and cover again as much as I can. Some of the elements which we're going to have a look at. Now, everything we talk through here, of course, we'll cover through your time with us at the Academy. And I'll just show you how I got to the trade setup. So the first thing that I'm going to look at is what we call volume profiles. Okay, volume profiles and also market profiles. Now, this is quite an unusual way of looking at the charts. Most people tend to look at, a candlestick chart like this. Okay, if it's moving higher and lower, and it just represents a change in the value, a change in the price. These profiles are just a different way of looking at that. And what they're showing us here, the black boxes or profile, is showing us where have we spent time each week. Okay, so this here, for instance, this is a weekly pairing. Okay, so this represents a week. The left-hand side is where have we spent time. So this little, I must be able to change this pen so it's a little less ridiculous. Make it a bit smaller, surely. Let's try that again. There we go, it's a little bit better. So that's a week, okay. Sorry, team. Hopeless, absolutely hopeless. Fortunately, I won't be teaching you how to use this. Right, this is a week's profile, okay. Here, where there is a sort of a bulge in the profile, we have spent a lot of time there. Here, where there is less of a bulge, we've spent very little time. Okay, the volume profile, which that's the market profile, the volume profile, which is the right hand side, the purple, shows us, it looks very similar, but rather than showing us how much time we've spent at a level, this is showing us how much volume has been traded, how much cash has been traded at a level. And it can show us a huge amount about what is likely to happen within the market and going forward. Do you need big capital to increase your odds of success? No, not at all. You can, with the right technicals and the right plan and the right setup, you can be successful with £100 versus £100,000. Yeah, that's not going to change your chances of success at all. How much money you make, yeah, if I make 10% on £100, and I've only made 10 quid. If I make 10% on 100 grand, I've made 10 grand. So, but 10% is still 10%. Someone making 10% on £100 account is better than a trader making 2% on £100,000 account, in my opinion. They've got way less money, but they're a better trader. How do funds consistently make money if stock prices only reflect publicly available information and adjust conditions quickly? Yeah, well, the first thing to say is funds don't always make money, but funds play a much longer term game, and they tend to play a trend-based game. So rather than short-term trading like we are, they will have a lot of larger exposure to long-term bonds, for instance, or long-term equity indexes, or long-term equities in general. Now, if you look at an equity index, for instance, or individual equities, they have a tendency to move higher. And certainly if you sit in bond markets, you can profit from the yield coming in from that bond, from just the loan. Now, if you're not trying to make 10, 20, 30% a year, and you're quite happy just ticking along, making 5, 10% a year, then actually that's relatively simple, okay? Because you can go with very low risk trades, low risk assets, and you can work on the basis for 10% a year on 200 billion, is a lot of money. For us as traders, the more short term, you tend to have less capital. You want exposure to more opportunities, more volatility. So you tend to look at slightly riskier assets. Funds will take a much longer term view on just generally this is going to increase in value over the next 2-3 years. Makes life a lot less sketchy, a lot less volatile. That makes sense. Okay, so things that we've got on this profile which are quite interesting. Firstly, I want to look at this week down here. Okay, right at the bottom of this week, we have what we call excess. Okay, and hopefully you can see there's very little time spent down at the bottom there. Compare that to the top, where actually there's quite a lot of time. Oh, my word, I've done it again. There we go. Okay, versus the top, where there's quite a lot of time. Okay, now imagine a dodgy neighborhood, right? If you walk into a dodgy neighborhood with your family, you are going to turn around and get out of there as quickly as you possibly can. Yeah, in this instance, the price has come down to this area, and it has then really aggressively gone back up. It's telling us that down there are a lot of buyers. Okay, in here we had a lot of buyers. At the top, okay, actually we have the opposite of that. We've spent a lot of time. So that's telling us we're quite happy trading at these prices. So down here, there's really aggressive buyers trying to force the price up. And up here, there's not much selling. Actually, we're quite happy trading these prices. We're now in a nice part of town. It's got a nice playground for your family, whatever it is. You're going to spend some time there, and you're probably also going to spend some money there. Okay, so this is called excess at the bottom, and it suggests there are really strong buyers. Most recently, I've got this D shape. It's a balanced day, okay, or in this instance, week. And when you have a balanced week like this, what it allows and what it creates is an opportunity for big institutional buyers, big investment banks to accumulate positioning, right? To buy more and more and more and more. So when a market is balanced like this, it's used by the institutions to try and accumulate big position and do it somewhat under the radar without creating moves in the market. So this D shape is a really good indication that perhaps buyers are looking to get involved in this market. What we've also got here is what we call a support level. Okay, at this low. Okay, this is a low of a week. It's also this big volume area. So there was loads of volume here. So people spent a lot of money, okay, here. And then there's this support level where the price is unlikely to go beneath the weekly low. All right, so I've got support from the weekly low. I've got support from where people previously spent a lot of money. And I've got this really aggressive buying down at the bottom of the day. Yeah, the thin bit shows less transactions, exactly. Yeah, so if there's less volume on the purple bit, if it's smaller, it says less people have traded at that price. So looking at where we are here on this shape, this is a really strong sign. A lot of people were interested in trading here. The market then moved higher. So this is majority of people are buying in here, which of course is then a positive thing. So I've got a bit of an area here. So the purple is how much volume has been traded at a given price. Okay, so how much money has changed hands. And the black is how much time have we spent there. Okay, so at the bottom here, we didn't spend a lot of time and we didn't conduct a lot of trade. Up here, we spent a lot of, oh God, this thing's really annoying. We spent a lot of time and we conducted a lot of trade. Yeah, so that's saying we accept those prices. We're quite happy at these higher prices. Okay, so let's keep moving forward and then we'll get to that. How do we know when to enter into the market? So that's one reason why this potentially could have gone up. Let's carry on our journey. That was on a weekly chart. Now on the daily chart here, we can see these three profiles. This is Monday, Tuesday, and Wednesday. Okay, the market was going really sideways. And again, with excess. So it showed us there were strong buyers at the bottom and there were poor highs at the top, which are weak sellers. That's when we spend a lot of time up at the top. Okay, you can see that a lot of time there. And also here, very near the top of the day, again, a lot of time. If you spend a lot of time somewhere, that implies the market is quite happy up there and it's likely to keep going higher. So the excess at the bottom suggests I'd like to buy this. The poor highs at the top also suggest I would like to buy this. Yeah. Really key elements for this volume and market profiling, just showing us that buyers are in control. So from the weekly profiles here, it suggested buyers were in control. Okay, from the strong buying and this big chunk of volume and the support from the low of this week. And then we've come down to the daily time frame, seeing everything in a bit more detail. And again, I can see the same thing. Strong buying down here at the bottom on the previous day, and then weak buying up here, weak selling, sorry, up at the top in the form of these poor highs. Okay, so plenty of reasons to want to be a buyer. Now, when we come down then to a candlestick chart, and what we're looking at here is this is the same price action. This is exactly what we were looking at on the profiles, but this time it's candlesticks. So this big spike down here, and then this rapid move back higher, that is this profile. This big, on the left-hand side, this big spike down and then move back higher. Okay, so that's just how it looks like on a candlestick chart. Now, what we've got here is that same strong support level. You can see here how the price is bouncing off of it, bouncing off of it, bouncing off of it. It's holding up the price, and the reaction at that level looks pretty good, right? We can see the buying pressure is getting stronger and stronger. So that, again, a positive sign at that support level. How many hours a day we should spend on the charts? Okay, somewhat dependent on your strategy. If you're like me and you're very short-term intraday, I spend a lot of time on my charts. You know, I might spend 4, 5, 6 hours a day looking at my charts. That isn't necessary. Okay, that is necessary for my strategy because I'm very short-term, fast-paced, looking to take multiple trades a day. A lot of you are going to be juggling a full-time job and family and life alongside this, or you simply want it as an opportunity to make a bit of extra money. In which case you might trade slightly longer term, take trades that last 2 to 3 days. And with those trades, you probably only need to analyze a chart once or twice a day, perhaps in the morning before you go to work or in the evening when you get home from work. Set up some analysis, set up some orders, and then check back in 2 or 3 days to see what happened. So you can do either. You can either be really aggressive and really intent and spend a lot of hours on the chart, give you more tradable opportunities and have faster paced trades, or you can take a step back and balance it alongside work and life commitments and spend maybe half an hour to an hour a day looking at the charts. Okay, so yeah, it's somewhat strategy dependent. Like I said, for me, I'm quite intensive looking at the charts. Paddy, our academic dean, he tends to spend very little time looking at the charts because he tends to sit in trades for 2 to 3 weeks. Okay, so here we are. We have this really strong support level. And what we also have is an indicator called relative strength index, okay, which is this momentum oscillator at the bottom. Now, I'm not going to explain fully what it is, but this is like a bungee jump. Okay, it's like a measuring the amount of stretch within a market. If, for instance, when the RSI got up here, okay, very, very high, that's like throwing a tennis ball up in the air and that tennis ball reaching its peak, right? The momentum has gone out of that throw, it's going to turn over and it's going to come back down. Likewise, when I get to the bottom here, that's like the bottom of a bungee jump, right? You free fall, you go very, very quickly, quicker and quicker and quicker. The bungee stretches, and eventually that bungee is stretched as far as it can. All of the momentum has gone out of that free fall, and then you start going back up. That's what we're seeing here on this momentum indicator. So when this market is down at the bottom of the indicator, trading down here towards what we call the oversold zone, this is like the bottom of the bungee jump. Right? That has stretched, the price has gone down too far, it's stretched out, and it needs to have a bit of a correction and perhaps a move back higher. So these secondary tools, these oscillators, can give you, help you determine Spartak asked the question, exactly when would I enter this trade? Some of these secondary tools now, like the RSI and the primary tool of the support level here, are helping me now time my entry. Okay, so the momentum here is showing me sellers are starting to lose momentum. And of course, I'm looking to be a buyer here. I want to buy into all of the fundamental and the macro reasons that we talked about. And now that those sellers are at the bottom of the bungee jump, that's as good a time as any to see this market move back higher. Okay. We've also got what we call a price pattern here. And this is what's called a double bottom. Okay, a double bottom, you can see where these two green circles, you have equal lows on the price. And those equal lows just suggest that the sellers, again, are losing control. And generally, your opportunity to trade that is when the market comes back above that, what we call the neckline, which is this blue line coming across here. Trade back above that neckline, and that gives you the confidence and the confirmation to say, yeah, okay, buyers are stepping in, time to potentially go and execute this trade. Is it better to adopt already existing concepts to trade or to spend time in markets and develop our own kind of strategy? Okay, yeah, you need a strategy that works for you. And when I say you, really, I mean your psychology. That's going to be the biggest pitfall for most of you as new traders. It's going to be, can you control your emotions, and can you develop a strategy that leaves you as little exposure to your faults and your weaknesses as you can. I am far from perfect with my trading. I'm never going to pretend to be anywhere near that. I need a strategy that limits how susceptible I am to making mistakes, and what mistakes are going to be different for all of you. So yes, you need a strategy that's designed for you, and yes, spending as much time in the markets as possible is critical when you're starting to learn. But that being said, you do still need to have the foundations, and you do still need to understand the technicals to be able to achieve that. So it's a little bit of both. I don't think you can do one without the other, but certainly time in the markets is critical. Yes, you need a strategy that suits you, but you can only come up with that strategy if you understand the technical concepts in the first place. I personally don't think you can kind of plug and play a strategy that's just going to suddenly work and make you money. I don't think that's particularly achievable. Educated, yeah, informed gambling, I would suggest, isn't it? You never know the outcome. So yeah, you are just trusting a little bit to gambling. But if you're putting all of the tools and measures in place, come the end of the day, you should be profitable. Okay, so we've got our double bottom. Now, we've also got a moving average here. You can see a moving average is this red line. Okay, and it's there to help me confirm multiple things. One, where can I see support and resistance? Where can I see the market moving back higher or lower? And the trend. Okay, generally speaking, if you are beneath the moving average, that is a negative thing. If you are above the moving average, that is a positive thing. So here we can see we are beneath the moving average, and that moving average is pointing lower. The price, the market, has then come above that moving average, and it is now staying above. You can see that candle dip below, found some buyers, and moved back up above the moving average. That's a really positive signal. Okay, that's telling me this market does not want to trade beneath the moving average. That is now a positive signal, and I'm looking now to be a buyer. Okay, so we are now down to execution territory. I've got my double bottom. The price is above the moving average. The momentum indicator is saying buyers are in control, and the profiles, those volume and market profiles, also showing me buyers are in control. And of course, on top of that is the fundamental and the macro view supporting a long trade. Okay, so this is a relatively short-term trade. We're looking at around a 4 to 5 hour trade, but this lasted. So this was right on the upper ends of my typical trade duration. Okay, and what I'm looking to try and do here is execute this trade. I'm just going to jump forward a couple of slides. Execute this trade above this blue resistance level. Now that blue resistance level is if the price gets back above the neckline of this double bottom. Okay, so you see that blue line running across there, which is the neckline where we said if it breaks above, there it is. If it breaks above that blue line, I want to buy. This entry was trading if it went back above that neckline. Okay, the stop loss. Okay, where am I ultimately wrong about this trade? So my entry, buy above the resistance. If that ceiling gives way, if we can punch a hole through the ceiling, get me into the trade. My stop loss was beneath the recent low. It's just saying, where would I put that stop? Where am I wrong about this trade? On everything we've talked about, the Australian dollar should go up against the Canadian. So where am I wrong? And if I start breaking, if this moves higher and it breaks above this neckline, it should really start doing this. If it starts to fail here and break through some of these lows, then I was wrong. I got my timing wrong. I no longer want to be a part of this trade. Get me out of the trade. Let me move on to another trade setup. Okay, and my target is going back to, looks like quite a big target up here. It's almost off the screen. Actually, what I'm looking at there is I'm going back to our profiles, and I was looking to target back into some of these highs. Okay, if ever you're looking to plot support and resistance in the future, team, previous session highs are really significant. And here I had two, the high from the 4th and the 6th. Okay, so big significant resistance highs. And I just felt if we could break through, we could see a run up towards those recent highs. That was what we were looking for. Okay, this market had a really aggressive breakout. Okay, and it also gave me an opportunity to do some in-trade management. As this market moved higher, I was able to consistently lock in profits. Okay, just trailing my stop loss behind some of these swings within the market, some of these small little moves. Okay, I didn't want to put myself in a position where I got a really good start to the trade and we moved higher, and then I gave it all back and took a stop loss. So what I did was I just trailed and I moved my stop loss, okay, behind the trend. So as this zigzagged its way higher, making higher highs and higher lows, I had the opportunity to move my stop loss, which is the red line here. So my first move was to here. So ultimately, I came back to where I entered the trade. The second move behind this low, so I'd make a small profit if it came back down, then to here. Okay, notice how we had this resistance, the price came above, retested that level and then went up. That was the evidence I needed that this could keep going higher. So then I moved my stop loss to here to lock in profits as we go, and then I moved it to here. So worst case scenario, if this hadn't quite reached the target and it pulled back, we still would probably have ended up with a pretty reasonable, maybe a 3-to-1 risk reward ratio or something like that. Okay, so the execution of this trade then, I risked 1%. Now I didn't actually risk £1,000. Okay, I've just put arbitrary values for this, but just for argument's sake, okay, we risk £1,000, like 1% of £100,000 account. to make a 4.8% trade up to this high. Okay, so end up with a 4.8 to 1 risk to reward ratio. This trade took around 4 hours, something like that. We got into it around midday London time and got out just after, so just prior to 6 p.m. London time, so around 6 hours, something like that. Question coming here. Can stop loss eliminate the fall failing in the market? Yeah, so the purpose of the stop loss is you're going to be wrong, right? At some point, you are going to take a trade and you're going to be wrong. Okay, for me, my hit rate sits a little under 50%. So 1 in 2 trades, I'm going to be wrong. So if that's the case, I need to make sure I know when to cut my losses. And I'm quite happy to take a 1% loss. If I consistently lose 1%, but when I win 2% or 3% or 4%, or in this instance 4.8%, that's going to make me very, very profitable. Okay, so the aim of the game is to cut your losses as quickly as you can. When you're wrong, accept that you are wrong and move on. When you're right, try and make as much from that trade as you possibly can. Okay, and if you can be a 50-50 trader, win one, lose one, win one, lose one, but make sure your gains are greater than your losses, you will be profitable. You don't have to be a genius here. You don't have to get every single trade right. In fact, I would strongly encourage you not to try and do that. I think you're fighting a losing battle. You just need to make sure that when you win more than you lose. And if you consistently do that, you will, come the end of the day, be profitable. Okay. So my technical setup, again, I'm not expecting you to fully understand this. Okay, obviously, I'm just trying to show you some tools. Those of you which have got some trading experience, hopefully this is useful and shows you a different way of trading, perhaps. But it started out with the profiles. The profiles on the weekly were showing me buyers were in control, we were at support, and we were seeing accumulation of positioning. On the daily, they also showed me buyers were in control, and we were seeing again that build in pressure. From a charting perspective, we had a strong support level and we had our momentum indicator suggesting sellers were fading and buyers were starting to show their dominance in the form of bullish divergence. Okay, bullish divergence here. We can see the momentum is going up, this green line, whilst the price is going down. Okay, bullish divergence suggesting positivity. We then had the double bottom, okay, which again suggested positivity, and we had the move above and through the moving average. Okay, that was what we needed from a technical point of view to say, yes, I've ticked enough boxes here. This is now a high probability trade. I'm long. I'm getting involved in this. Okay, from there on out, it was about the execution and getting the entry, the stop loss, and the target, again, based on levels from our analysis. Yeah, the entry was based on the double bottom neckline, and then the target levels were based on previous resistance. Okay, it wasn't I just close my eyes and click buy because fundamentally it makes sense. The process was fundamentally this makes sense. From a macroeconomic data perspective, this makes sense. And now my technicals are showing me this is the exact time I should buy. This is the exact place I should get out if I'm wrong. And this is the exact place I should get out if I'm right. Knowing when to take your profits, also just as important as knowing when to get out of the trade. Okay, so that then pieces together a full trade setup from initial concept of fundamentally and macro what's going on, from a central bank to inflation to growth. We looked at the correlations between S&P and the Australian dollar. We looked at the bond markets. That all told us the Australian dollar should go up against the Canadian. And then we had the technical to tell me this is exactly how I'm going to execute the trade. Okay,